Welcome to The Explainer. Today we're tearing right into a massive financial mystery where mainstream headlines completely detach from reality. We're looking at a truly bizarre anomaly where geopolitical chaos and global conflict somehow acted as rocket fuel for the stock market.
Okay, let's dive into this. Because honestly, it's the ultimate paradox of modern finance. Logically speaking, war disrupts supply chains, it destroys infrastructure, and it creates massive, sweeping uncertainty. And if there is one thing markets absolutely hate, it's uncertainty. So why on earth would the stock market hit all-time highs while global conflicts are actively escalating? Well, to find the answer, we have to look entirely past the daily headlines and uncover the hidden underlying mechanics of Wall Street.
Let's start by grounding ourselves in the actual timeline of events that set this whole thing up. On February 28th, following strikes in the Middle East, the Strait of Hormuz effectively shut down. By March, the market was suffering its absolute worst 5-week losing streak in nearly 4 years, with the S&P dropping almost 9%. Then, suddenly, on the evening of April 7th, a ceasefire is announced. And the very next day, April 8th, the market experiences an absolutely massive rally.
But here's the catch. While your everyday retirement account was quietly bleeding out during March, the largest institutions on Wall Street were maneuvering. This is a classic look at how the rich get richer during times of war. The number 300% is absolutely crucial here. According to prime brokerage data from Goldman Sachs, hedge fund gross leverage was sitting at over 300%. That is near an all-time high. The biggest, wealthiest players were selling at the fastest pace in 13 years, heavily shorting the market. It's a perfect example of how massive institutions use their scale to aggressively position themselves to profit from impending panic.
And believe me, that panic was very real. The sentiment on the street was just completely bearish. Just listen to this stark warning from commodity analyst Rory Johnston during that time. He mapped out a scenario where oil prices could hit $250 to $300 a barrel if the disruptions continued. He literally said, recession is too light a term. We're talking depressionary. So fear had completely gripped the market.
Then came the spark. On the evening of April 7th, out of nowhere, the sudden announcement of a ceasefire was broadcast out. Given the extreme doom and gloom positioning of those massive institutional funds, this sudden, unexpected news acted as an absolute shock to the financial system.
The next morning, it was like someone just flipped a switch. The S&P closed up 2.5%. The Nasdaq climbed almost 3%. The Dow soared over 1,300 points. Meanwhile, crude oil plummeted over 16%, which was its biggest drop since April 2020. Traditional financial media immediately jumped on the airwaves, and they slapped a label on this explosive move, a relief rally. They confidently told the public that the markets were simply celebrating world peace.
Now, what's really interesting about this data is how it completely destroys that mainstream peace rally narrative. This data comes from Windward, a maritime intelligence firm that uses AI and satellite radar to track actual physical shipping. Look at the numbers here. The pre-war baseline was about 130 daily transits through the Strait of Hormuz. By midday on April 8th, right during the height of this so-called peace rally, there were only 5 transits. 5. That is a 96% decrease. Shipping had practically completely stopped. The physical reality of the war hadn't changed one bit.
So we have a major problem here, right? If there was no actual peace on the ground and global shipping was still entirely paralyzed, what on earth actually moved the markets so violently upward? If it wasn't the geopolitical fundamentals, well, it had to be the market's internal mechanics.
Section 1. The 3 mechanical dominoes.
To understand this, we're going to look at the cascading mechanical triggers that forcefully push stocks to the moon. Think of these as 3 massive dominoes. Domino 1 is the classic short squeeze. Remember that 300% leverage and massive short exposure we talked about? Well, when you short a stock, you borrow shares and sell them, betting the price drops. But when that ceasefire announcement caused a slight, unexpected bump in prices, those short sellers started losing money fast. Their brokers issued margin calls, forcing them to buy back the shares at a higher price just to cover their positions. All that forced mass buying pushed the price up even higher, triggering more margin calls, and boom, a massive upward spiral began.
Once the short squeeze got the ball rolling, the second domino fell. The algorithms kicked in. Specifically, systematic trading firms known as CTAs, or commodity trading advisors. Now, these are entirely emotionless machines. They don't watch the news, they don't care about geopolitical strategy, and they certainly don't care who announced the ceasefire. They just follow mathematical trends. If a trend is going down, they short. But if a trend reverses and goes up, their models mechanically flip to buy.
And flip they did.
Going into this event, Goldman Sachs noted CTAs had a massive net short position, but the exact second the S&P crossed specific technical trigger levels, those algorithms reversed course entirely. Over just 5 trading sessions, these emotionless machines were forced to mechanically buy back $86 billion worth of equities. $86 billion. It was literally one of the fastest purchasing sprints in recorded financial history.
Which brings us right to our third and final domino, the options market. Options dealers are the folks taking the other side of your options trades. Now, to protect themselves, they have to stay delta neutral. This is just a fancy way of saying that, to keep their books perfectly balanced, they constantly have to buy and sell the underlying stock in real time as the market moves.
Leading up to this ceasefire, data platforms flagged that the market was in a negative gamma regime. This is a highly volatile condition. In this regime, when the stock price goes up, options dealers are mathematically forced to buy more of the stock to stay balanced. So the price goes up, they buy more, that buying makes the price go up again, so they have to buy even more. It is a massive pro-cyclical feedback loop that basically pours gasoline right onto the fire. So the crucial point is this. The April 8th rally wasn't about world peace at all. It was just these 3 dominoes falling in rapid succession. The initial news sparked a macro short squeeze. That pushed prices high enough to force the algorithmic CTAs to flip from short to long. That drove prices even higher, which forced options dealers to blindly buy stock just to hedge their books. A completely artificial 100% mechanical rally.
Section 2. How the market changed, then versus now.
If you're wondering why the market behaves this wildly today, you have to realize that this domino effect isn't some rare one-off glitch. It is the new normal. Just 20 years ago, the market was dominated by humans. You had actual human portfolio managers reading earnings reports, analysts modeling cash flows, and people making discretionary decisions about what a company was fundamentally worth. Today, that market is effectively gone. It's been completely replaced by algorithms, blind passive funds, and options dealers reacting on autopilot.
Take passive investing, for example. Today, a staggering 63% of all U.S. stock funds are held by passive indexers. We're talking about more than $13 trillion of blind money. This money doesn't read earnings reports. It just follows the index on autopilot, buying more of a company simply because it's already big, totally ignoring the actual underlying performance of the business itself.
And what's left of the active investing side? Well, it's completely transformed too. It's consolidated into a handful of giant, highly leveraged multi-strategy funds. Again, this just highlights how capital concentrates heavily into institutional hands, ensuring the biggest players maintain their edge. These multi-strategy funds run at 4 to 8 times leverage with incredibly strict mathematical rules. When they hit a drawdown limit, they don't sit around and debate geopolitical nuances. They are forced to sell immediately.
And this brilliantly illustrates the final piece of the modern puzzle. Look at the absolute explosion of zero-day expiration, or zero DTE options. Same-day options now make up around 63% of all S&P trading. On peak days, over $2 trillion of notional value changes hands in a single session. Every single one of those options forces a dealer on the other side to hedge in real time, buying or selling the underlying stock instantly.
The market we used to know, the one about finding undervalued companies and investing for the long haul, has been fundamentally rewired. As our source material perfectly sums it up, what's left is a giant feedback loop of algorithms, passive funds, and options dealers all reacting to each other in real time. The geopolitical headlines we see on TV, honestly, they're often just convenient narratives constructed after the fact to rationalize the blind, mechanical movements of the machine.
Which leaves us with a rather terrifying thought. We've just seen exactly how this mechanical feedback loop can artificially force the market to rip to all-time highs on the mere whisper of good news. But if the entire modern financial system is just a giant web of blind algorithms reacting to each other, what exactly happens when they all simultaneously decide to sell at once?